Are you tired of putting your hard-earned money into investments and actually making profits? Boy, do I have an alternative for you. Enter Cathie Wood, the queen of hype-driven investments. Her Ark Innovations ETF promises the moon and sometimes even delivers for a while. But is her strategy sustainable or just a roller coaster fueled by speculation? Over the past few weeks, I reviewed multiple value investor portfolios that teaches us how to build long-term wealth. This is my 5th portfolio breakdown, and today we're flipping the script. Instead of learning what to do, we're diving into Cathie Wood's portfolio to understand what not to do. Also, consider subscribing to not miss out on future portfolio breakdowns and valuable insights on value investing. Now, let's explore why chasing the hype might not be the best way to grow your wealth and why value investing offers a more stable path forward. Cathie Wood's Ark Innovation ETF gained massive attention with staggering returns. They gained 36% in 2019, 150% in 2020, and 68% in 2023. Those numbers captured headlines and investor dollars, building her reputation as a visionary. But let's pause there. These returns didn't come from solid, profitable companies with proven track records. They came from chasing what's hot: AI, blockchain, and other buzzworthy sectors. In essence, her strategy revolves around hype. While the allure of investing into groundbreaking tech is undeniable, it comes with massive risks. The issue with hype is that it is unsustainable. Over the past 3 years, Ark Innovation ETF has returned an abysmal -32% annualized return. Compare that to the S&P 500, which managed to grow by 10% during the same period. And here is why. Hype-driven stocks often lack fundamentals, stable earnings, competitive advantages, and reasonable valuations. These are the pillars in value investing, but we're missing in Cathie Wood's portfolio. Instead, her strategy bets on companies with lofty promises, but no guarantee of delivering real, sustainable growth. And that is the key reason why ARK funds are so volatile. Now, let's take a look at the numbers behind Cathie Wood's Ark Innovation ETF. Here are ARK's top 10 holdings. What stands out here? 4 of her top 10 holdings are not even profitable, with Archer Aviation not even having revenue. And the companies that make money are showing sky-high price-to-earnings ratios, with an average of over 120. Meaning investors are willing to pay over 100 times earnings for a slice of these companies. While some might argue that the growth and future potential of these companies justifies this, it's hard to ignore how inflated this valuation is. Let's take a closer look at Palantir, which has the highest PE ratio among these companies currently. It's trading at an eye-watering almost 350 PE ratio. Now, let's assume Palantir grows its revenue by 30% annually for the next 5 years. With its profitability and valuation remaining the same, after 5 years, even with that high growth, the company would still trade at a staggering 93 PE. Now, let's get even more optimistic. If Palantir's profitability grows at an aggressive 20% annually, which is extremely bullish, after 5 years, it would still be trading at a lofty 40 PE. This isn't just speculative, it's borderline irrational. These numbers reflect a broader trend in Cathie Wood's ETF. High valuations for companies that aren't even profitable yet, coupled with overemphasis on speculative high-risk sectors. The key takeaway here is that even if a company is growing rapidly, there is still a limit of how much you can justify paying for it. Morningstar recently named Ark Innovation one of the biggest wealth destroyers over the past decade, with shareholder losses totaling $7.1 billion. And across all Ark's funds, the number jumps to over $14 billion. This isn't just volatile, it's destruction of wealth. Investors who bought into the hype at its peak are now sitting on massive losses. Meanwhile, value investors focus on limiting downside risk by investing in businesses with solid fundamentals at reasonable prices. I know, it's not flashy, but it's a proven approach that works. Cathie Wood defends her approach by arguing that traditional investment metrics do not apply for her chosen sectors. She believes that technology is rewriting the rules and that her funds are paving the way for the future. The problem is, betting on the future doesn't mean ignoring the present. Without strong fundamentals, even the most innovating companies can fall. Wood's reliance on instincts and aggressive trades is another red flag. Value investors rely on analysis, not gut feelings. They understand that markets often overhype trends and they wait for the hype to settle before investing. The contrast between Cathie Wood's strategy and value investing couldn't be clearer. Value investing prioritizes long-term stability and focuses on companies with intrinsic value, strong cash flows, and competitive advantages. Hype chasing, on the other hand, thrives on speculation and short-term gains. It may deliver great returns for a few years, but the long-term track record often disappoints. Cathie Wood's story is a reminder: the market rewards patience and discipline, not chasing the next shiny object. So, is Cathie Wood an innovator or just a hype chaser? The numbers suggest that the approach isn't sustainable for long-term wealth creation. If you're serious about investing, remember this: value will always outlast hype. So what do you think about her portfolio? Would you invest in Ark funds? If you enjoyed the video, consider subscribing and clicking the like button, as it does help to grow my channel. And as always guys, thank you for watching and I hope to see you in the next one. Bye.